Andy Walden, the Vice President of Enterprise Research Strategy at ICE, is joining me now. Good morning, Andy.
Hey, good morning, Trinity.
Great to have you. So let's just dive in here. So how do you expect what we saw from the Fed yesterday to impact 30-year mortgage rates?
And as you were just discussing, it's not necessarily what the Fed did, right? We know the Fed kept rates stable. It's more the Fed tone and the words that they used yesterday that's kind of reaffirmed the suspicion that the Fed will begin easing rates in September. When we look at how the bond market has reacted, bond yields, especially 10-year bond yields, which tend to drive mortgage rates, down a few basis points from where they were yesterday, which suggests that ICE conforming rate that you just showed, 6.75 roughly, could drop a few basis points, get down into the 6 2/3 range. Now, I think the broader question is, does that change long run expectations for the mortgage market? If you look at composite rate forecasts there for rates in the 6 2/3 range by the end of this year, low 6% range by the end of next year, maybe this pulls those down slightly, but that's kind of what we're looking at here over the next few months and next few quarters, is rates kind of gradually easing as we move towards the tail end of this year and throughout 2025.
And what does that current rate outlook mean for mortgage lending and the broader housing market as we make our way through the tail end of the year?
Yeah, it's a good question, right? And when you look at the housing market and you look at our latest ICE home price index, the housing market has been cooling off here over the last couple of months. We went from a little over a 6% year-over-year home price growth rate back in February. We're now a little over 4% right now. And if you look at how June performed, if we continue to trend at that level, you can see that annual home price growth rate dip into the mid 3% range here over the next few months. Now, the interesting piece about where rates are at right now, right? Given the recent 10-year Treasury declines, 30-year rates are kind of at their lowest level since late January, early February. We had seen a little bit of a heat up, a little bit of an uptick in the housing market last time rates got to this level. And so that kind of begs the question, have we gone from this cooling to potentially a little bit of a modest reheat out there in the housing market with rates easing a little bit? We'll be watching that closely. We'll be keeping an eye on, obviously, purchase applications of the demand side. Obviously, a little bit more inventory out there right now than there was early this year when we were last at rates at this level, but could see a little bit of a shift in the housing market here over the next couple of months, something worth watching. From a lending perspective, I think that one's interesting as well. Not only are we kind of at the same levels that we were from an interest rate perspective in late January and February, we're almost identical to where we were at this point last year in terms of interest rates. But in terms of refinance incentive, we're in a very different spot because the market has broadly lived above this interest rate range over the last 12 months or so. So when you kind of look at the dynamics of the mortgage market, there are twice as many in-the-money borrowers today as there were a year ago. There are 3 times as many highly qualified refinance candidates as there were a year ago. So perhaps some modest growth here over the next few weeks in refinance activity. And I kind of emphasize modest. We're still talking historically low levels, but a little bit of a positive storyline there for refinance lending in the market.
And I understand you're going to be speaking about the latest on homeowner equity on your monthly mortgage monitor call this afternoon. And there are some interesting tie-ins there as it pertains to the Fed expectations, right? So can you give us a little preview on the latest data and what it's showing out there?
Yeah, absolutely, right. And we've seen mortgage debt gradually rise here over the last few quarters. We actually hit a record high here in terms of total first and second lien mortgage debt in June, but what you've seen is home price growth outpacing that debt growth, and that means strong equity positions. Mortgage holders out there have $17.5 trillion of overall equity, the strongest level we've ever seen. $11.5 trillion of that is what we call tappable, meaning that could be borrowed against while still maintaining a 20% equity cushion on every property in the U.S., also a record high. And then when you look at debt leverage in the market, it's still relatively low, right? The mortgage market is about 44% debt, 56% equity right now, which means lower loss risk out there in the market. And the tie-in that you mentioned at the Fed meeting is those Fed interest rate dynamics, specifically drive second lien home equity interest rates out there in the market. And as the Fed has raised interest rates, those second lien HELOC rate offerings have been in the low 9% ranges in the early stages of this year. If you look at that Fed dot path, right, or that dot plot or future Fed rate path that you were discussing earlier, it says over the next 15 months, maybe a 1.5% to 2% decline in the Fed funds rate. That could directly impact the interest rate offerings on those second lien products, right? So instead of low 9% home equity lines of credit, we could be talking mid 7% as we get into late 2025. Could spur a little bit more activity out there in terms of second lien equity utilization, renovation activity, and the like.
A lot of important information right there. Thank you so much, Andy, for joining us.
Absolutely. Thanks for having me.